Thanks for those of you who signed on. We're trying this for the first time this week. We thought we'd have a little fun at the beginning of each one of these and just share what we call the meme of the week. And this is kind of something we can all relate to now um, with with the current situation that we're dealing with. I don't know if y'all can see this yet or not. Anna found this one, and I think we can all relate to that. It's it's kind of like today. I guess we're all on the right side of that with video, right? So anyway, we'll look for one that we can share each week, and I'm here at my home. I've got an extra room where I've got all of my, I guess you'd call this my version of a man cave here, and I've got it set up to do a lot of these video sessions. So what we talked about as a group was this has been going on for about 3 weeks for us, operating virtually, and I know for some of you it's been that long or longer. One of the things that I personally have noticed in our team that's talked about, and we have we call it a morning huddle every morning at 8:30, where we all get on and talk about the day and the week. And one of the things that I've noticed is there's so much information coming at us that after a while, it just sounds like noise. And yet there's a lot of important stuff coming out, particularly in the world that we operate in is financial planners, wealth advisors, money managers. And so we thought, we should try just hosting a live session each week where we let you guys connect with us a little bit more personally than just over the phone. And that we share maybe a particular topic each week. This week, I'm going to talk to you about some very significant changes that have happened in just about the last about 3 months to 3.5 months. I mean, we've had some massive changes relative to RMDs. And so I thought, well, we'll carve that out this week and talk about that. We've already got next week for our Wise Counsel Live on Tuesday. We've got just talk about some basic perspective on as an investor looking at times like this when you're going through these times of unusual sell-offs and volatility. So we're looking forward to that. But each week while this is going on, hopefully not that much longer, but while this is happening, we're just going to pick a topic and kind of dig in a little bit. And that way, hopefully, if it's a topic you're interested in, you'll get a little more substance and not feel like it's just noise constantly coming at you. So we are going to record these, and we'll probably share them on our social media and our website and whatnot later on. I will say that unfortunately, the industry we're in is very regulated, and so as much as we would love to have a live chat question, and we're not allowed to do that. So because of that, we're going to invite you, if you've got a question relative to anything, for simplicity, so we'll know that we get your questions, send them to Anna directly, and then she'll be able to tell me at the end of this discussion if we have time. We'll try to deal with it during this discussion, or we'll call you back and talk to you directly about it. Anna's email address is annah@wisecounselwealth.com. So send a question to her by email if you have one. All right, so we've got about, looks like about 10 other folks who've signed up since we've been rolling here. Let me get into some of the meat of what we wanted to cover with you. You may remember, it seems like an age ago now, back in December, we had this Secure Act that was passed. And in that act, there were a couple of major changes to required minimum distributions. If you're interested in RMDs or required minimum distributions, it probably means you either inherited an IRA already from somebody who is deceased, or perhaps you're already 70 and a half or older and you are about to take them, or you were already taking them. So that act had a big change for all of us. The first thing it did was it extended the age to 72 when you have to take your first required minimum distribution. Now, the way that worked was interesting. If you were already 70 and a half sometime in 2019, then you are grandfathered under the old rules. And that will be the case going forward. But if you didn't turn 70 and a half until sometime in 2020, you are now under the new rules. And so that's an important change that we've already talked with many of you about, but that's something for you to be aware of. Now, another very significant change that happened in this provision was that we used to have this planning technique we called a stretch IRA. And the concept there was that you could name your children or grandchildren as beneficiaries on your IRA type accounts. And at your passing, they would then be able to receive that as a beneficiary in an inherited IRA or an inherited IRA. And the really powerful thing about the old rules was it allowed them to take their life expectancy, which if they were, let's say, 40 years old, their life expectancy might be 35 or 40 years, and they would just have to take out a small fraction every year in a required distribution for the rest of their lives. Really powerful if you left it to grandchildren, because they were so young that they would have 50, 60-year life expectancies or more. Unfortunately, that has been pretty much killed with the Secure Act. Now we're dealing with what, in most cases, there are a few exceptions, but for the most part, it's going to be whoever you name as beneficiary, other than your spouse, is going to have to pull all of that money out within 10 years of the date of death. So all of a sudden, that has created a lot of opportunity for reconsidering how clients are structuring their beneficiary planning regarding their IRAs, particularly if your estate is made up of fairly large IRAs. That's a big and important question. And so we have a lot of thoughts in our shop about how you can effectively change course a little bit on how you're going to do your planning there. So those are two big changes that happened before anybody even had heard of this thing called COVID-19 or coronavirus. And we had already put out a lot of education and information about that in January and February. And then all of a sudden, we got hit by this very unusual set of circumstances we're all living through right now, where we have shut down voluntarily, essentially, a $22 trillion economy, and we're all looking at each other now on Zoom sessions. There's been a lot of positives that have come out of this, one of which is that we've all been forced to get up to speed on technology that we might have otherwise just ignored. But it has been obviously a shock to the system. And in response to that, of course, we've had some major legislative reaction coming out of Washington. By now, you've heard many, many times about the CARES Act that was signed into law a couple of weeks ago. Actually, I don't even think it's been 2 weeks yet. But we have an incredibly deep bench of very sharp folks in our Carson ecosystem. And one of them in particular, Jamie Hopkins, has just been all over this from day one. We had a summary of the act out 5 days after the president signed it. We've already done multiple webinars, but today I want to drill down into several retirement-related provisions, particularly required minimum distribution provisions. The first one I wanted to highlight to you, and the most universally important, is that this CARES Act has eliminated all RMDs for the year 2020. And that is true if it's your own required minimum distribution, or if it's an inherited account from somebody that passed away and left you their IRA, one of those inherited IRAs. It's true if you were already taking RMDs before this, so maybe you had one in 2019 and you normally would have to take one in 2020. You don't have to do that now. It presents some really interesting planning opportunities. Zach, why don't you unmute yourself, and I want you to speak to, we brainstorm this stuff all the time. I'd like you to take a second and just speak to what this means, where somebody could maybe do some interesting Roth conversion planning. Just take a minute and speak to that.
Yeah, so normally if someone has an IRA account and they are having to take, let's just say, their required minimum distribution, the IRS requires them to take $30,000 or so every year to, they have to take it out and pay taxes on it. And say their income, the household income's maybe $80,000, and then they have the $30,000 on top of it. In this situation, for this single year, there's an opportunity. Basically, most of the people listening right now on the call that are over 70, you guys have a year right now where your income is likely to be lower than it is in the years following this one, just because that $30,000 chunk, let's just say, is not having to come out. So it's not hitting your tax return. For that reason, it's kind of a one-time opportunity to say, hey, my income's lower this year than it's ever been, and my taxes are going to be lower than they've ever been. So maybe I'm down in a lower tax bracket, or maybe I'm just deeper into the one that I was previously. And so instead of having to take that money out and just put it in the bank, you can do a Roth conversion. So we can take that money out and move it into a Roth account. So basically when you do that, you're turning your money that you have that's right now that you have to pay taxes on, you're turning it and converting it into tax-free money. So once it's in that Roth account, it can grow and there will never be tax on again. So the money that goes into the Roth is never taxed. All the growth on it each year is never taxed. And then when you finally pull it out, when you do need it, it's not taxed then either. So it's basically creating a bucket of tax-free money. Of course, if you take that out and you put it in your bank account as normal, or even a non-IRA type account, then there's going to be some taxes over time. So you might have to get some piddly little interest in the bank on that money, and then you'd pay tax on that. Or if it grows in an investment account, there'd be tax. But it's basically a really cool one-time opportunity if you're over 70, 72 really, to do a conversion like this and at a lower tax rate than people have ever done it before. So we think it's a good idea.
Thanks, Zach. And I'd missed if you covered this or not, but a lot of times people don't realize that the law and IRS law doesn't allow us in a normal RMD year to even convert an RMD amount. So you would have, if you were going to do a conversion and you're already 70, you would have to pull your RMD out first. That's fully taxable. And then anything on top of that you pulled out to convert to Roth conversion would be additional taxable income. Anna?
There was a question, can you convert an annuity to a Roth account?
Well, that's a great question. An annuity is kind of beside the point. The question is if the annuity is in an IRA, then the answer would be generally yes. You can't take an annuity that's not already in an IRA and convert it into a Roth account. It has to be in an IRA. But generally speaking, it doesn't matter what's in the IRA. It is potentially eligible to be converted to a Roth account. The key is it has to already be in a retirement account like an IRA or even a 401k. Good question. So we think that there's opportunities for some Roth planning here. These things the rules are somewhat technical, but what's even more complex is that every family is unique. The circumstances are unique. Your tax profile is unique. It's just one of these things where you can't just read an article and say, oh, that sounds like a great idea for me, because it may or it may not be. You really need to look at this in the bigger picture. And that's, of course, what we like to think we excel at doing. So before you do anything or make any decisions, please just chat with us about it. And let's look at your overall plan to make sure that we come up with the best solution for your circumstances. One other thing I want to mention about this, the most obvious planning, I guess, decision you could make regarding this one 2020 waiver of RMDs is to just not take it. And we have many clients who take RMDs every year. Anna is tracking these things. I thought I would kind of give you an example of where you really should be communicating with us. I would say, Anna, probably 3/4 of the clients that we work with wait until November roughly to take their RMD once a year. But we do have some that take it quarterly, some that take it monthly. And so let's say that somebody is on a monthly distribution with us, right? If they don't want to take any more out of the rest of the year, what should they be doing?
So for anyone who takes a monthly distribution, those will continue going as normal unless we hear from you that you want to discontinue doing that. A lot of clients do rely on these monthly distributions for income, but if you are on a monthly or quarterly automatic distribution, there will be no automatic changes. However, if there is for TDA accounts, which the majority of our accounts, if you have an annual one-time RMD distribution scheduled, TDA is doing us the courtesy of automatically canceling those. So if you want to continue taking those, just let us know and we'll make sure those go out. But TDA is doing us a favor to cancel those automatically, and they'll restart automatically starting 2021. So there'll be no action on your part, but it's a case-by-case basis. So I would suggest if there's anything that you need specifically for your case, to give us a call or to get in touch with me, and we'll make sure to get the distributions sent out or canceled.
Thanks, Anna. Yeah, I think before the end of the year, we probably need to talk to every one of you and just make sure that everybody's on the same page. But if you are in a situation where you're taking money out already, then just assume it's going to continue unless you take steps to contact us and we have that discussion, and then we can stop it if you want to. That's, I guess, the most time urgent part of this. Otherwise, we've got time to deal with this later on. I'll give you another example. Let's say that just to kind of illustrate this rule before we move to a couple other points, let's say that you have a neighbor, and that neighbor's father passed away on December the 30th of 2019, and they left your neighbor a big IRA. And so that would be an inherited IRA. And you would think, well, normally the RMD wouldn't be due until the end of 2020. It's the year following the date of death. And that would be true. But this year, that RMD is waived. You don't have to take it, number one. Number two, in that example, the father passed away just about on the last day of 2019. And so your neighbor is going to be grandfathered under the old rules. They won't be under the 10-year rule. Had the same scenario happened and the father had passed away on January the 2nd, you still wouldn't have to take an RMD this year, but you would be under the new rules, the 10-year rule. So that's how arbitrary this stuff can be sometimes, and it's why it's so unique to just the individual circumstances. So I'll just say, if you have questions about that particular point of the CARES Act, or if you have friends who aren't sure what to do about their RMDs, we're more than happy to help answer questions for not only existing clients or anybody you might point our way. So let's shift gears and talk about a couple of other interesting provisions in this CARES Act, not really directly related to RMDs. A lot of folks right now that are impacted by this virus, either economically or health-wise, they need to know about these two provisions that were also included in the CARES Act. One is a special hardship withdrawal. Congress approved the ability to take up to $100,000 penalty-free withdrawal from your retirement accounts. And normally, if you weren't 59 and a half, you would pay a 10% penalty on that. Now, they're still going to say that withdrawal would be taxable. However, they're going to let you spread that tax out all in 2020 if you want to, because some people, if they've lost their job, that might be a better thing for them to take that as taxable income in 2020. But if that's not to your advantage, you can spread it out over 3 years. You also have the ability to pay the tax not only over 3 years, but also you can repay that money back into your IRA, and they won't count that against you for your normal restrictions on how much you can put in a year. So it's a way to tap into your 401k or your IRA early if you really need help, and have some flexibility on not having to pay the penalty tax and on the timing of the tax, or even putting it back in. The last thing I'll say about that is if you did wait let's say to that third year to pay that money back in, you would have already paid tax on 2/3 of it because you recorded a third in one year and a third in the next year. They will allow you to go back and file amended returns and get a tax refund for the tax on that if you pay the money back in. So that's a really unique opportunity for planning that came out of this act. Another one is similar, but it's a different idea, and it's regarding loans. If you're still employed at an employer that has a 401k or a 403b that allow plan loans, normally tax law allows you to borrow up to $50,000, but you had to have at least 100 in that account to be able to do the 50. What they've done for this season is they've increased it to 100, and they'll let you borrow up to 100,000, up to 100% of the account value, capped at 100,000, and you don't have to make payments in the first year. So this one could be a really, really good way to get some short-term liquidity out of your 401k plan. This one's tax-free. You don't have to pay taxes on that loan as long as you end up paying it back eventually. And they've doubled the normal amount you can take out, and you don't have to make payments in the first year. So there could be a number of planning reasons why you might need some short-term liquidity. And that is another provision that really popped out at us when we looked at this. So the last thing I want to touch on today, and then we'll see if we got any other questions. We get a good number of questions about charitable contributions, and I wanted to hit on two things related to that. Number one, they have added, this is a fairly small amount of money, but they have added what they call an above line deduction of $300 for charitable contributions. So they just took away most people's ability to itemize deductions and get a tax deduction for your charitable contributions a couple of years ago, because they raised the standard deduction so high to $24,000 for if you're married filing jointly, $12,000 if you're filing single. For most people, their itemized deductions weren't more than that. So even if you were recording your charitable contributions on your Schedule A, you weren't really getting a deduction for it. So when this all kind of cranked up, they said, well, we'll allow people to take a $300 deduction above the line. So it's not a ton of money, but I mean, if everybody used that as an excuse to give $300 to maybe the local food pantry or whatever your favorite ministry or church is, that is a deduction you can take. The bigger one is in what are called qualified charitable distributions. Some of you already use this strategy. This is only available if you're already at the age 70 and a half, or now it's going to be 72. But if you're already at 70 and a half, you had the ability to do charitable giving directly from your IRA to a qualified 501c3 charity. And the advantage of that was that as long as it was reported correctly on your tax return, it would be as if that money was never taken out of the IRA. And so therefore it was a tax-free distribution essentially. It also was allowed to be viewed as part of your required minimum distribution. So that raises some interesting questions. These different rules and changes kind of work together. In 2020, there are no required minimum distributions. So one of the first questions we got was, well, can I still do my qualified charitable distribution this year from my IRA? The answer is yes, you absolutely can. And you can absolutely still record it on your tax return the same way your accountant would have. And it will be as if you never took the money out. So in essence, you're getting 100% deduction for that charitable gift when you give that way. The other question we got was, well, have they raised the age going forward to 72 for my qualified charitable distributions? And the answer is no. Don't know if this was an oversight. They may come back and change this later to line up the ages, but for right now, the age is still 70 and a half. So you can do some advanced charitable giving directly from your IRA starting in the year you turn 70 and a half. And it's much more tax effective to give that way if you're already at that age and you have those circumstances that allow you to do that. So those are some probably the most meaty provisions that we saw related to IRAs and RMDs. And We've actually recorded another video of me hitting on some of these topics already. I think it just went live on our website. We also have webinars we've done. We're really trying to find good ways to get this information out, because we really want to help people know what's going on, so you at least know what questions to ask. Anna, did we get any more questions while we've been talking?
No other questions so far. I just want to let everybody know that if you have any specific questions about your specific situation, you can email me, and if I can't answer them, I'll defer them to Bob or Zach. So just reach out if y'all have any specific questions regarding your circumstances.
Yeah, so, you know, this was short and sweet. We're going to try to keep these to about 30 minutes. And, you know, you are welcome to join us. We really wanted this to be a client-only thing where, you know, this isn't just some big production. This is us doing one more thing to try to communicate important information to our clients. You're our top priority. But I do want to let you know that, you know, it's not going to be a problem if you want to invite a friend or something, you want to share the invitation, that's fine. Feel free to do that. But we are on our end keeping this to just going out to you, our clients. We want this to be a place you can hang out with us each week, see some or all of our faces, and just have a chance to interact with us a little bit. We're always available for one-on-one discussions, obviously. And I already mentioned earlier when we were just getting started, we've already got lined up for next week, Scott Kuby. Scott and his team have done a phenomenal job throughout this season. We have a meeting with them pretty much every morning at 7:30 a.m. and we hear the latest on what their views are on the market. We also talk about specifics in our individual investment strategies. Scott is just a really, really bright guy when it comes to investments, a lot of experience. And I asked him, I said, Scott, you know, they can hear me talk all the time, but I'd like you to come in with us next week and let's just talk about perspective. I've been in the business for almost 40 years now, and this is my fourth major market sell-off like this I've lived through. And you know, I want him to come in and give us his perspective on, you know, what does this look like if you back away from the timeline a little bit and you say, how long does it typically take these kinds of cycles to run their course in days or months? It really helps, because when the bullets are flying and you're caught up in the heat of it from day to day, especially if you're consuming too much news, it can really grind on you. And so it's good to get some perspective. So we'll be doing that next week. And I guess I'll close by saying one more thing. We're working on a more, I guess, rounded out way to do this. But if you're like me, you're having lots of conversations online with family members, maybe with neighbors, chat groups, whatever. And I have to know you're running into people who are really worried. You know, we feel like you guys, all of you know, we're here for you, and we're helping keep you focused on your plan. We're helping answer your questions. You know, all you got to do is raise your hand and say help, and we're there. But not everybody has that. And so one of the things that we've talked about as a team is, what can we do to make ourselves available to people that our clients know, where we can genuinely help those folks who are worried and maybe they don't have a team like ours to turn to for advice and guidance and perspective. So we're formulating what we call a second opinion service that we're going to make available, and it's really just going to be us making ourselves available, no strings attached, to talk to somebody who wants to get an opinion, an informed opinion about what's going on in their life and what changes, if any, they might want to think about making. So we're working on that. I would just encourage you, if you know somebody who's worried, and I mean right now, who doesn't, right? Encourage them to take advantage of this. We're here. You know, one of the blessings we had as a team is we were so well prepared to operate in a virtual environment like this. All of our core systems were already cloud-based. Even our phone system was already cloud-based. So we literally decided, all right, starting, what was it, 4 weeks ago, we said, we're going to start operating virtually. Everybody packed up their dual screen monitors, their computers, and some of us took our phones and we all went to our corners. We plugged in, and we've been meeting every morning since. And we are literally just as effective now as a team as we were before this happened. We hate not being able to sit in the conference room and meet face to face, but we can easily onboard new clients right now. And at the very least, we can certainly have conversations with people if they're worried and they want to say, well, you know, I don't know what to do about this RMD stuff, or I lost my job and I don't know what to do about this 401k stuff. And I mean, there's so many questions, and it's just infinite, the combinations. That's why we love what we do, because it's always unique. It's always an individual story with each family. So I'll just leave you with that thought. We'll go ahead and wrap this up. I'll give each of the team a chance to say hello or goodbye or whatever y'all want to say real quickly. Sydney, you go first. Anything you want to add as we wrap up?
No, we definitely, we miss seeing each other and seeing our clients, you know, but other than that, it's everything as normal. So, yeah, it was a pleasure getting to see some of you virtually.
Yeah.
It's nice to see familiar names, so
Yeah.
it's good.
Anna?
Just want to say hey to all our participants. You know, thanks for coming and joining us, and be sure to share any information you've gained from this. And we're here to help in any way. So just give us a call or email or any way we can help.
Stephanie, your turn.
Thanks for everyone that came and participated, and also hopefully I'll be talking to you on the phone, because I'm here still answering the phones.
And Zach?
Yeah, I guess just the word I'll say is it's difficult. The hardest thing is not knowing how we can help or who we can help. Everybody has stuff going on in their life right now, and so please reach out to us and let us know however we can help. Look forward to talking to anybody that wants to give us a ring, whether it's something that actively needs attention or just wanting to touch base.
Yeah. Okay. Well, thanks everybody. And if any of you out there find a particularly funny meme of the week related to Corona, email it to Anna and we'll vote on the best one for next week. God bless. Have a great week. Thanks for showing up. We'll talk again soon. Bye-bye.